Yuka joins us here in the studio. Very good evening to you.
Hey, Mark.
China's President Xi Jinping continues his tour of Southeast Asia. He's arrived in Malaysia after Vietnam.
Yeah, well, unlike Vietnam, which trades far less with China than it does with the United States, Malaysia has kept China as its top trading partner for years. It's also a major energy producer and it's the world's fifth largest exporter of liquefied natural gas. During the visit, Xi is expected to discuss a free trade agreement between China and ASEAN, as Malaysia is currently chair of the regional bloc. Luke Schrager has more.
A warm welcome for Xi Jinping in Kuala Lumpur as the Chinese president arrived for a three-day visit where trade is right at the top of the agenda.
It's always important that we strengthen and reinforce with all our trading and investment partners, and China, of course, is one of them. Coincidentally, it is happening at a time when the world is facing these new challenges on tariffs.
With a $25 billion trade surplus with the United States last year, Malaysia is facing tariffs of 24%, currently on a 3-month hold, and local businesses are scrambling for new markets. That leaves Beijing as Malaysia's largest trading partner with a well-timed opportunity as it seeks to show itself as the standard-bearer for stability and free trade. Hot on the heels of signing a raft of deals in Vietnam, Xi is also likely to be discussing further ties with the Association of Southeast Asian Nations, of which Malaysia currently holds the rotating chair.
Now the negotiations on version 3 of the China-ASEAN free trade area have come to an end. Both sides will expand mutually beneficial cooperation in emerging fields such as the digital economy, the green economy and supply chain connectivity.
That regional supply chain connectivity, though, is precisely what has irked Washington in recent months, as it seeks to weed out Chinese exports funneled through third-party nations to avoid eye-watering tariffs levelled at Beijing.
Luke Schrager there. Meanwhile, Beijing reportedly asking its airlines to stop buying Boeing jets.
Well, this according to a report by Bloomberg. The Chinese government ordered domestic airlines not to take any further deliveries of jets from the US aerospace giant and also to stop buying aeroplane parts from American companies. It marks the latest in the escalating trade war between Washington and Beijing and yet another setback for Boeing that's been struggling to recover from the fallout of last year's labour strike and safety crisis. China's 3 largest airlines had together planned to take delivery of around 180 Boeing planes over the next 3 years. Higher tariffs imposed by Donald Trump could have consequences on the aviation sector as a whole. In the United States, Delta has said it will defer deliveries of Airbus jets rather than pay higher costs. Now, Boeing's shares dropped as Donald Trump accused China of reneging on a deal with the company. It slid as much as 4% in earlier trading before recouping some of the losses. Engine maker Lockheed Martin is also sliding more than 1%. Wall Street's main indexes have all dipped into negative territory after starting the day on a positive note following a global rally. Earlier in the day, European stocks rose quite strongly, with London and Frankfurt advancing at more than 1%. Car makers led the rally after Donald Trump hinted on Monday that the auto sector could get some reprieve from his 25% tariffs. Now, traders, though, say volatility is here to stay amid continuous uncertainty caused by the US administration's fast-changing trade policy.
Since Donald Trump took office, volatility has returned to the stock markets. The markets are hanging on his every word, so things remain volatile and choppy. Ultimately, nobody knows what will happen next. It's an erratic trade policy and the stock markets are fundamentally unsettled. This can also be seen on the bond markets and the foreign exchange markets, where the US dollar has fallen sharply and yields on US government bonds have risen.
Well, the luxury French giant LVMH, or LVMH, perhaps I should say, had a bad day on the stock market. Do explain, Yuka.
Well, LVMH, or Louis Vuitton Moet Hennessy, it's
well said.
Fell around 8% this Tuesday, a day after the group reported an unexpected 3% drop in sales in the first quarter of this year, missing analyst expectations. LVMH generates a quarter of its revenue in the United States and also owns high-end champagne and cognac brands. As its share price fell, it was overtaken in market capitalization by rival Hermès, which it once famously tried to acquire. Mark.
And finally, tech giant Google suffering a setback, this time in Japan.
Yeah, Japan's competition watchdog issued a cease and desist order against Google in the first major antitrust move in the country against the global tech giant. The regulator said Google had been running a monopoly by having Android phone makers pre-install and give higher visibility to its search engine over its rivals in exchange for use of its Google Play App Store. The decision came following an investigation launched in 2023, similar to those in the United States and in the European Union. Google now has to stop the pre-install practice or face possible fines. And that's it for business for now.
Yuka, thank you very much indeed. Yuka back, of course, with more business as we go through the evening. Thank you.